Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host
Welcome,
for The
everybody.
Mortgage Voice,
I'm Jeff Barton.
Jeff
I'm your voice
Barton.
for the mortgage industry. This is the Mortgage Voice, and I appreciate you listening to the show. Each and every week we come on and we talk about mortgages, we talk about what the rates are doing, we talk about some of the availability of properties in your particular area. San Bernardino and Riverside counties, I want to say, hey, we have KCAA, KMET, blasting our signal out there about 4 or 5 times a week, as well as K Tahoe up in Northern California. We have a lot of new listeners there, plus our affiliate down in New Mexico. We have update on that, Darryl?
It's all a matter of dollars and cents.
I see.
We can talk about it when we're
If I have the dollars, it might make sense?
It might make sense.
Okay,
yeah.
Very good. Thank you very much. So we're trying to expand the audience, bring to you some additional areas. And why is that important? The show's always taken the viewpoint that what goes on in other parts of the country actually are interesting and also informative because California is expensive. I was just reading online that a great many of the newer residents in Las Vegas, Nevada are Californians. As a matter of fact, last year now Henderson is one of these small towns, actually not a small town, it's a bigger city, which is really in Clark County right next to Las Vegas. So if you really were to drive in, fly over, you couldn't tell the difference between Henderson or Summerlin or Las Vegas proper. It's all big one city. Anyway, 61% of the new residences in Henderson are from California. So there's a lot of ways that the show tries to expand what we're doing. And the reason, obviously, people leave California is because it's expensive here. That's why they drive over and find that the cost of living in Nevada is cheaper. So we bring some perspective. We have some people who come on the show from all different areas of the country, whether it be out in Illinois or in the Southeast, Florida and Georgia and places like that. Certainly Texas and up in the Northwest in Washington. So if you have relatives in those particular areas, or if you're looking to move there, or have somebody who wants a mortgage in those particular areas, wants to learn more about what goes on in the process, go to YouTube. Our show is on YouTube. If you can't hear it, KCAA, KMET, obviously, you can go online and listen anytime they archive the shows, but also on YouTube. Our show is easily accessible. If you go to YouTube, type in my name, Jeff Barton, and the name of the show is a little different. It's The Real Estate Voice, not The Mortgage Voice, The Real Estate Voice. And you will see that there are hundreds of shows there that you can see. Either it's the Mortgage Voice or the Las Vegas Real Estate Show, which we do once a month. We go out there and we shoot 3-4 episodes, and then we broadcast them at Retro TV at 26.4 on the broadcast dial, and it's on cable, CenturyLink cable out there as well. But finding information for you to make decisions about real estate purchases, about whether you want to refinance, about all kinds of things. There's so much that goes on and so many different aspects of the business itself that you need to know. Obviously, the main thing in San Bernardino and Riverside counties this year, and that's our main focus today, is basically affordability. What can you afford? We're looking at what's happening in the employment sector. Obviously, everybody's working. That's a good thing. A lot of people are actually making a little bit more this year than they were last year. I guess the tax refund issue got sorted out because now most people are receiving a good-size rebate if, in fact, you are a W-2 or a person who files Easy File. Those checks have gone out and are going out from the federal government to you. So you might get $3,000-$4,000 back, and what are you going to do with that, and how is it going to help you in terms of if you want to buy a house and maybe you want to look to FHA, and because in that particular scenario, you only have to put 3.5% down, but affordability is the issue. If we've got $350,000, the median home price in San Bernardino or Riverside counties, that means 3.5% is $10,000, $12,000. Well, if you've got a $3,000, $4,000 check coming back from the federal government, yeah, that gives you partial what you need to come up if you need an FHA loan. A lot of people don't want an FHA loan because it's a little bit more expensive. And I say a little bit more, you have to come up with an upfront fee, plus there's mortgage insurance that you need to take care of on a monthly basis that can raise your monthly principal, interest, taxes, and insurance bill by a few $100s every month. Now, for those strapped families, those families that really are looking at how they can afford it, and again, affordability, you have to look at what the cost of acquisition, meaning how much is that house going to cost, okay? Can I afford the monthly payment? Let's say you can afford the monthly payment, right? Let's say it's, $2,500 or it's $1,500, whatever the case may be. And you have the down payment, 3.5%. Now you have to look and make sure that the debt to income ratios are correct. Debt to income ratios being the fact that, okay, I have this much money coming in every month that I can document. And that's really, really important because when the lender's underwriter goes to look at that particular file, your file that comes in the door, they have to be able to see that you can pay the loan back. It's called the ability to pay rule, repay rule. So if you can get the documentation together that shows how much income you have, that income ratio is debt to income ratio, and then there's, of course, the mortgage to income ratio. It has to be less, I guess, 50%. Let's say 50% of what you make goes to your mortgage. If you can get to that to whereby it's a documented thing, then your income, then you basically can afford that house. If you can't, or you're saying, hey, look, I really make money, but I don't report it all. So the debt to income ratio is going to be off because the provable income is only, going to give me 60%. Well, that's not going to work at all. There are programs, and we talk about it on the show. I'm going to have a couple of guests on the show that'll talk about different ways by which you can finance things, either through your business or through your personal bank statements. It's going to cost you a little bit more in the rate, but you can be able to use business bank statements, personal bank statements. There are even stated programs coming back to the market, the dreaded stated program. Now, what does this mean? Usually means that you got to have at least 20-25% in the property because they want to make sure that if you've got skin in the game, yeah, we can lend you the money. But if you're looking for 100% financing or I don't know. Do you remember, Daryl, back in the old days when we used to be 105, 110?
125.
Yes, exactly. We will lend you 125 on 125%, meaning that if you have a 80% loan, 80-20 loan, and they're lending you 125%, it's a 100% loan.
Yep.
It's unbelievable. Well, no, that's not what's happening now. Although there are, people get nervous in our business, and there's a good reason for it. The mortgage business was the main cause for the economic collapse, according to all sources, mine included.
And it's also the main way people get wealthy in the world.
Absolutely. I mean, it's a type of thing where if you're on top of your finances and you can afford, the affordability thing is really important. The debt to income ratios, a lot of other, things that you need to do in order to be able to prove you can afford that house. But with the stated loan programs coming back, meaning that I'll tell you how much I make, or bank statement only programs from your business, meaning that you're running a lot of money through your business. However, does that mean that you can afford this house? People are nervous in the marketplace. There is some statistics out, and I want to get to it in another segment, about how much risk has grown in the marketplace, the mortgage marketplace. Now, it has been traditionally, and I say traditionally, meaning in the last 5 to 6 years, really low and going lower each and every quarter. But this particular quarter, Q4 from 2018, it grew. So I want to get into that a little bit and talk about why that is and what the risks are and how the mortgage industry will balance risk with the need to continue to do loans. Look, everybody out there in our business has to do loans or they're out of business. So then what are you going to have? You're going to have no choice in the marketplace, and that's no way to actually get a mortgage. So more choice is better. People out there in the marketplace who need choice, remember that documentation on the ability to repay equals affordability in whatever marketplace. And there are other choices other than Southern California. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for listening to the show, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now,
Welcome
to the
back,
Mortgage
everybody.
Voice
I'm Jeff
with
Barton, your voice
host,
in the mortgage
Jeff
industry.
Barton.
888-713-2929. That's our telephone number. If you pick up the phone and give us a call, we can help you with your decisions you're going to be making about money this year. And when I say money, I mean money to purchase real estate. It's going to be a pretty good year, i.e. the economy is still pretty strong. Employment numbers are up, although there is some speculation that we're going to have a little bit of a recession either at the end of this year or the following year. But any time that you can afford a mortgage, you can buy real estate. And affordability is the key to the whole equation. One guy that we bring on the show a lot, and he talks about how he helps businesses grow by supplying them with business capital, is Reed Blake from Business Capital Experts, and he's on the show with us today. I wanted to ask him a little bit about how his program is going. Reed, how are you?
I'm doing very, very well, Jeff. Thanks for having me back. I appreciate it.
Thank you very much, and I hope you're feeling better, and things are looking up.
Yeah, we're improving a little bit. I may cough once or twice.
Oh, okay. Well, that's quite all right. There's a lot of that going around.
Really?
Okay, so access to business capital. Explain to the audience a little bit about how the program works. I know there's several different ways it can work.
Right. Primarily, the two that would, for the average real estate investor, that would probably be the most important are what we call UBLs, unsecured cash-based business lines of credit, and unsecured cash loans, or UCLs. Now, the unsecured business lines of credit, again, cash-based, I'm emphasizing that so that anybody that might be familiar with corporate credit doesn't confuse it with vendor credit.
Right.
The Lowe's and Home Depot type cards. But these are actually, cash instruments. And so the lines of credit are monies that we refer to as forever money. You get to use them over and over and over and over again. So again, just keeping the math simple, if you had a $10,000 line of credit, you get to draw down 5, pay it back, draw down 7, pay it back, draw down 1,000, and draw down 2,000, pay it back. You get to use it over and over and over, and your limits go up and things like that. Unsecured cash loan is a loan. It's more of a traditional type of funding, other than it's unsecured. It has a start date, an end date, and amortization schedule. And so both are unsecured, which means that the business owner can use that capital however he or she chooses. They're in complete control of it. It's not like a hard money loan or something like that. You go to the bank, you get a loan, and you have to list the 5 things you need money for.
Sure.
And the amounts you need for each category. You could just deploy this money however you choose.
So if you're a business, let's say you're a business owner, you own, any number of different businesses, you can take the money from this and go out and purchase real estate with it.
Yeah, you can purchase real estate with it. You can purchase equipment with it. You can purchase advertising. However you, the business owner, would see however to deploy that capital so that you make wise use of it.
Right.
You're in control of it.
What is the cost of what is the cost of money like this?
Interest cost is that's a great question, Jeff. On the unsecured business lines of credit, the UBLs, right now the marketplace is so competitive for the small business owner's business that it's interest free for between 9 and 24 months, depending upon who the funding source is. On the UCLs, it's, again, based upon the quality of the file, the credit file itself. But right now we're seeing interest rates that range from a low of 5% to a high of 11%.
I see. Okay. I just got off the phone with a representative. There's a company out there called Angel Oak, and they do non-QM type loans, right? Not your space, but similar in that their credit requirements are not what they would be if you were a Fannie or a Freddie Mac type loan. He told me because the space is so crowded in the non-QM world, they've just reduced their interest rates by a point across the board to try to snatch up business from its competitors. Is that how competitive it is with your business as well?
Yes, it is. And that's why you see these offers, so to speak. In other words, once we get the client with the funding source, then literally some are 9 months interest free, some are 24 months interest free.
And what kind of terms are you giving, or what kind? I guess that would mean that there's, because of the fact that it rolls over. I guess once you establish your line of credit, you get the first 24 up to 24 free, and then after that, if you keep using it, there's whatever the interest rate is. Is that what the investor or the person giving the money is looking at?
Yeah, you've got it exactly, and so it's called resetting. So
Okay.
it resets. It will reset. Typically, they reset annually.
Okay.
And it's whatever the market rates are. It's not like some teaser thing, and now they're charging rapacious amounts of 25, 30, 35 percent.
Right.
It's not that. It's whatever the market rates are at that time for unsecured funding. Okay, and so whatever it is in 24 months, that's what it will be. We're seeing rates this year set for clients, or we've had for 2 years, all between 6 and I've seen as high as 14%, and that's based upon what's called the IIS, the internal institutional score that each funding source maintains on that client. So based upon their experience with the client, how they thought they handled the money when it was interest free, determines kind of what you get then. Then we have our clients. We do a little appeal process, and about 50, 60% of the times our clients get up to a 25% reduction in the fees, or not the fees, in the interest rates.
I
So
see.
it may go from 10 to 8, might go from 11 to 9, something like that, upon what we call appeal.
And how often do the loans last more than 5 years? Is this kind of a thing that stops after a certain time, or I guess it depends on the business, right?
Well, that's a great question. It really depends upon. Technically, a line of credit would be forever.
Right.
As long as the client is handling the money wisely, they'll have it forever, and the limits will go up and go up and up. I actually have a colleague who is with an institution. One of his lines is with an institution that he can't stand. He wouldn't work with them in any way, shape, or form except that he got a line of credit. He's at the point now where he gets an automatic $50,000 limit increase every single year. In fact, this year he's probably going to go past the $1 million mark.
Wow.
With that one funding source alone. On the unsecured cash loans, that's different. I mean, that's a cycle. In other words, you can do a 1 year, a 3 year, 5 year, 7 year, 15 year, whatever term you set up with that funding source.
Now, let me ask you a question on the underwriting standards. What are they looking for exactly? I guess every client's different. Every funding source asks for something different. But what are some of the standard underwriting guidelines, I guess you'd say, to borrowing this money?
Right. On the unsecured loans, UCLs, that tends to be more of a general, traditional underwrite.
Right.
So they're going to be looking at the credit score. They're going to be looking at income, things like that. But typically speaking, if the score is 650 or higher, they'll probably get funded right now on unsecured cash loans. Income has to be there to support the ability to pay back, to meet the payments on the loan. Things like that. Debt-to-income ratio comes into play again. On the unsecured business lines of credit, that's different. There, the requirements are you have to have a business, right? Because they're unsecured business lines, not unsecured personal lines. So it has to be a business, but there's no seasoning requirement. We can form a business on a Wednesday. They can be getting funded by the following Friday. The next one's going to be credit, but it's not score-driven, Jeff. It's blemish-driven. So, and this will sound weird. There are good blemishes and there are bad blemishes.
Right.
And so we just do an evaluation on each client to decide whether or not they're going to get the funds. The next of the 4 qualification criteria is what we call capacity, and
Okay.
that's the limits of their personal credit.
Right.
Okay.
Right.
So if they've got 30,000, 3 $10,000 cards, they've got 30,000. If they've got one $10,000 card, they have $10,000 in capacity.
Right.
The person with $30,000 in capacity will get more money than the person with $10,000.
Right.
And then the last is what's called utilization, where you and I would say charge. How much money do I have charged on the file?
Right.
And so the sweet spot, we get funding for anybody at any level, but the sweet spot for the UBLs is 35% or less. Those folks are all going to get $50,000 to $100,000 in round one.
Right.
On the UCLs, 45, depending upon the file, 50% on we can stretch it, then they'll get funded as well.
Hey, Reed, could you shout out your phone number for your Business Capital Exports number so people want to get in touch with you, they can call you right directly?
Hey, Jeff, I appreciate you, man. I'm going to do one better. I'm going to give everybody my cell number.
Okay, excellent.
And they can reach me directly at 801-830-6240. Again, that number is 801-830-6240. The office number is again, 702-536-6322.
Reed, thank you very much for coming on the show. I always like to hear about the excitement that you can bring to what you're offering people, and I hope you got a bunch of calls on this.
Oh, thank you. I agree. And again, it's one of the funniest, places, one of the few places that not-for-profits can come, as well as, one-off type businesses.
Great.
Because we can fund non-traditional as well.
Thanks, Reed. Thank you very much. This is Reed Blake from Business Capital Experts. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929. That's our telephone number. Pick up the phone. Give us a call. Write down the phone number. If you don't want to call right now, you just want to listen to the show with your questions, you can always call us. We have an email address, info@malibufunding.net, which can help you if you just want to write it down and send it over. We do get a lot of requests for information, both on rates of what's happening in the mortgage industry. Some even ask us, I don't think you guys can help me because of my situation. Do you know anybody else that might be able to? And we absolutely do. We've been around a long time, and so if there's something we can't do, we'll certainly suggest somebody else. Vendors as well, home inspectors, all kinds of people, title, escrow, roof people. We've helped people for years, 20 years we've been around. So if you're out there right now and you're listening to the show and you're looking for information, this is the place to get it. We bring to the show each and every week a lot of different guests who come to us and try to share their information about what they have learned both in the industry, but also personally. We try to make it accessible to you, not just lecture at you. I hate that kind of radio show. Anyway, once again with us is Charles Giscombe. He's the manager of Malibu Funding out in the state of Nevada, as well as, he's a house flipper, a pretty good guy. Charles, how are you?
I'm doing great, Jeff. How you doing today?
I'm great. Thank you very much, and thanks for coming on the show. I really appreciate it.
Of course.
Okay, so what's happening? I know that you spent some time in New York State doing some house flipping. I know that you're currently working in the state of Nevada. Differences between different places in terms of problems, things that come up differently, whether it has to do with weather, whether it has to do with, credit score challenges, which may happen in a given area just because of the way it is. Give us your assessment of the different areas or what you might be able to bring for answers for these type of situations that come up in different areas.
Sure, no problem. In regards to the investment and the flipping situation, obviously in Nevada, the weather really never really gets bad. I mean, you might have some days where it gets a little bit colder, but you don't have the snow. You don't have to deal with those kind of different issues where your workers are working outside the house.
Right.
So obviously you can work year-round in Nevada, which is obviously a super, super advantage.
Right.
The one good thing about New York is when it gets that way, when you do get workers, they'll work hard. Because it's not that much business out there, so you get some guys. We'll get some work crews that work really hard, and we'll get the business as long as they can weather the storms, literally and figuratively.
Yeah.
Then everything gets done. In regards to the mortgages and what we do in the mortgages,
Okay.
The mortgage issues are universal. Whether it's the West Coast or the East Coast, doesn't really matter. Most clients that we deal with. Obviously we have great borrowers. We have A borrowers, and one beautiful thing about Malibu Funding is we work from borrowers that people would consider, the industry consider, quote unquote, A paper borrowers, all the way down to C and D paper borrowers. Jeff, we don't discriminate. We actually take everyone in. With the other banks, the bigger banks, with the A paper borrowers, they feel like, hey, this is the kind of clientele they want to deal with, and they don't really cater to the rest. But there's some really good diamonds in the rough. that just needs to be picked up and dusted off. If you're willing to take a couple extra steps, do a little bit more due diligence, you can see those B, C, and D level loans. They can really be turned around, and really it can be A-paper loans. You just have to help take the next step and help them structure it out. So in regards to mortgages, honestly, you have credit issues if people can't provide documentation. Obviously, also the way people make their money. There's a lot of entrepreneurs. They don't want to provide tax return and different things, Jeff, and don't have the 60 days bank statements or the 30 days paycheck stubs and the 2 years of tax returns and the W-2s. Obviously, you just need to take that person and transition them into another loan. It doesn't mean that it's not an A-paper loan or a good loan for a person. It just means that their situation and circumstances are different than the others. So as far as mortgages, East, West Coast, whatever it may be, I think that's they're universal situations, issues, problems, and hurdles that you have to jump or climb over, regardless of where you're at.
Do you think that the automation that everybody's trying to push, whether it's from millennials out there who seem to be taking over the world with the tech, or do you think it's still going to be a one-on-one personal relationship that gets you the loan done?
Jeff, we're from the old school. I'm from the old school. You're from the old school, and we know that there's nothing like sitting in front of a client, looking them in the eye, and talking to them about their options, their decisions, their thoughts on possibly the biggest purchasing decision of their life.
Right.
For me, when you're sitting in front of an individual across from them, you need them to understand that you feel them, that you've been through this before, that there's no such thing as dumb questions. And so I think that one-on-one, that face-to-face can never be met or matched. The automation just makes things easier, but the reality of it is there's still people behind the automation that needs to make those things happen. So obviously, yes, you can get the documentation faster. You can get it over quicker. You can order a credit report on your phone or different things of that nature, or you can put information into a loan originating system, the LOS. But at the end of the day, when we're talking about a person making one of their largest major decisions of their life, I think nothing can compete with individual one-on-one, hand-to-hand, I like to say, a loan originator.
Are you worried that the current crop of borrowers, younger borrowers, are not used to dealing one-on-one? So when they're trying to make a decision about buying a house, they're more, I guess not skeptical, but they're more reluctant to actually reach out and talk to somebody. So the purchases really aren't what they should be for a generation that large.
I'm in complete agreement. We always talked about this, just like we talked on the TV show, Jeff. Social media is making our young kids antisocial.
Right. No, that's well said. Right.
Unfortunately, I don't think that that's what the gist of it was to make people more social. But at the end of the day, I think that's what it's becoming. And if they can't see it on YouTube or Google or touching on the phone, then like you said, Jeff, they're not reaching out. The real individuals that are out there in the field every day, hitting the pavement, making this thing happen. So yeah, you're right. It's not going the way it should go. I think that if you have a proper mixture and dose of both things, then obviously you can get the best, the best outcome for your situation. But like you said, these kids, the days, the millennials, and don't get me wrong, it's a wonderful thing to have these individuals. These young kids are coming up and they're learning so much and they're teaching us about other things as well. But I think that you just can't get away from the old school, Jeff. I got to say it, the old school. I mean, you can't get away from just individuals putting the work in, and then individuals that have done so much that there are a Bible and a book, a history book that tell these kids, if you're having issues, if this doesn't work, most things are on YouTube, but not everything, Jeff.
Well,
not everything.
Yeah, how to relate and how to talk to people. You can watch somebody else do it, but to do it yourself, you need somebody first of all, it's a trust issue, right? So you got to be able to pick somebody that you trust. And however you do that, however you make it up in your head, once you reach that person, whether it's a good real estate agent or a terrific loan officer, you then have to develop a relationship whereby you feel comfortable sharing with them your most intimate financial details. And I don't think you can do that online or watching a video.
I completely agree with you. Just because you own a beautiful smartphone doesn't mean you're smart, Jeff.
Right.
At the end of the day, sometimes you got to go talk to some people that have been there so that you can figure it out.
Right.
You still have to do that. And like you said, when it's personal and you're talking to someone, there's no such thing as a dumb question, and you need somebody to feel that. And professionals, that's what we're here to do, Jeff. That's what we're licensed to do. Is we're here to take those insecurities, the idea of not knowing or not being smart enough. We're supposed to take those fears away from you and walk you through. And I always say our favorite saying is "earn while you learn," Jeff.
Right.
At the end of the day, that's what we want to provide to these younger individuals. We need them. They may need us.
Yeah, no, I agree with you, and I think that trying to understand somebody else is at the heart of what we do in the lending business, because once you really understand somebody, what they want, what they can afford, then you can actually help them. I think if hiding behind technology, no, use technology, but don't use it as a way by which you can separate yourself from your loan officer. Listen, we got 30 seconds left. Shout out your phone number for people who are looking for a terrific loan officer.
Hey, listen, if you want to get in touch, you want to get some business done with Malibu Funding, give me a call. You can call me direct at 702-328-5191. Again, 702-328-5191. If you want to email me at charles@malibufunding.biz.
Thanks, Charles, very much for coming on the show. Once again, always appreciate your information.
Jeff, thanks for having me. Always a pleasure.
Thanks very much. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. Pick up the phone and give us a call. My NMLS number for Malibu Funding, the company that sponsors the show, is 79620. If people are out there and wanted to know the licensing issue with me and how I became an expert in the mortgage industry and be able to come on the radio and help you in your decisions with both the financial decisions and whether you can, actually look at a piece of property and know that you can afford something. When you go and you want to buy something, the most important thing to do is to find a professional to work with so that financially you know what is and what is not possible. There are a number of programs this year that haven't existed for quite some time. Earlier segment talked about the dreaded stated programs that used to be the bane of the mortgage industry. And why do I say that? Is because the stated income brought on things like pick-a-pay. I don't know if anyone remembers what that was, meaning that you could go out there in the mortgage marketplace, get a loan, but then pick how you were going to pay. Either pay principal only, maybe you just pay interest, maybe you skip a payment. These pick-a-pay loans that were hugely popular at the last couple of years before the recession, 2006, 2007, would allow people to get into properties they never should have gotten into. So today we're back to stated income properties. And what does that mean? It means basically that you are telling the loan officer or the lender or whoever it is that's giving you the loan, this is how much money I make. Now, is it verified? No. But can you lie? The answer is no, you cannot lie. And the reason being is because they do actually check, whether they eventually go to a third-party vendor to check. People like the Work Number or the First American Title Company has a great product or two out there that can verify income, verify sources of income and employment. So the stated income, although that particular name is not the greatest out there because of the historical situation dealing with it, it is actually an okay loan. The main aspect of that stated loan is that you're going to need probably 20-25% into the property. So you have a $100,000 property, you got to bring $25,000 in so that you have skin in the game, and that's the most important part of any of these hybrid, used to be risky type loans. If you have money in the deal, the lender is saying, okay, nobody's going to walk. We have an ascending market real estate-wise, and I think this year in San Bernardino, Riverside counties, we will probably see a 4 to 6% increase in property values. Now, there it had been going up, quite frankly, a lot more than that, especially since we've been in this up market since 2010, where prices have really we've probably seen a lot of properties at 10% per year from 2013 maybe to 2017. That's a lot to go up in a short period of time. Now, there is a Rule 72, right? Meaning that every 7 years, your particular investments are going to double. So if you've got money in an 401 or you've got money in a money market, and the rule of 72, whether it being as an investment in a index fund or it's supposed to double every 7 years. Well, it's not that way in real estate. You're not going to see your real estate investment double every 7. If you did, the affordability index, which we were talking about earlier in the show, nobody could afford the house. So it doesn't matter what your property's worth. Nobody's ever going to buy it, so it's dead money. You want to say something, Daryl?
Well, as I remember, the rule of sevens is 7 multiple. It had to be 7 years and 7% profit, right?
Each year?
Yeah, in order for the combination to get it there. So
Yeah, I think, and especially if you're compounding,
Right.
which is what most people do in their investments, especially if it's a retirement account or something like that.
and you really can't get 7% anymore.
No, but I mean, the rule still applies in many of the investments. There are some investments out there, whether it be in index funds. Some of these index funds actually did pretty well, even last year when the market didn't do well at all.
Yeah, well, I mean, in the stock market, you certainly can get it, but
Right.
you've got to pick really well.
Yeah, well, you pick, and most people will tell you if you're older like we are, you're not going to want to have risky
Right.
propositions in your portfolio anyway.
Yeah, most of us are risk adverse at this point.
Right, you want to hold on to what
30
you
years
have.
ago, yeah, roll the dice.
Absolutely right. I can always make
lose
more
it all.
money.
I
Right.
can make it back.
Right,
Yeah.
exactly right, but not anymore. So if you are out there and you're looking for a great real estate deal, now's a great time. Interest rates, let's talk about interest rates for a minute. In the news to use section, there's an article by Andrea Ricoeur, Riquuier. I'm going to read just a portion of it, just so that you get a historical perspective on what's happening in the mortgage rates this year versus last year. She says that so far this year, the 30-year fixed rate has averaged about 4.42%. Now, when I say this year, I mean January and February. We will be in March or are in March, so that really hasn't come to fruition. But for those particular 2 years, if you go back in 2018, she said that in 2018 it was 4.54%. So really we're talking about a very similar interest rate a year later. And this is even after we had 3 Fed interest rate hikes. Now, we all know that that particular interest rate hike by the Fed doesn't directly correspond to what's going on in the mortgage market, in the mortgage rates, but there is a correlation. And normally when the Fed raises interest rates on your credit card, on your short-term loans, on your car loan, your credit cards, these type of loans that the Fed, and when they raise the rate, it does affect it. There is a correlation, as I said. So usually we see a corresponding rate hike in the mortgage market when there's a rate hike by the Fed. It's just the way it is, even though it's bound by the 10-year Treasury notes. And anybody who wants to follow this really closely, there are a couple of indexes, whether it be the seventh fund, what is it? The Fed has 7 or 9 different areas with which they cover in the United States. Each area can have a particular rate for that particular area, right? And it's usually very close. There's the 9th District Funds. There's the LIBOR, which is the London Interbank Exchange Rate. And there are some other rates out there, or exchanges, indexes that you use in order to follow where the mortgage market is heading, where the rates are heading. But right now we've got a confluence of events that really is making people nervous about both the stock market, the economy, trade with China, the job market overall. I saw a special last night. I don't know if you saw this. They were talking about the promises made in the political sphere during presidential runs and how the last presidential run, when Trump was running against Hillary Clinton, there was a promise of jobs for the coal industry.
Right.
Right? And the coal, guess how many people in the coal industry, in its entirety, how many people are employed?
30,000.
76,000, which is a very, very small number.
Yeah.
Just as an example, they were saying that J.C. Penney employs 115,000, just the one company,
Right.
not the entire industry, right? So the idea that coal jobs were coming back was a promise by President Trump. That it isn't happening, it's not going to happen, and those jobs are going away, and they're never coming back, like many jobs.
No, it was a strategy to energize the Midwest.
That's exactly right. So when we're talking about what's happening in the overall economy, the nervousness that some people have, there was also a map that came out that I saw that showed each state what was the number one opening, meaning the more jobs than any other job in that particular state. And predominantly 4 different areas were covered by, the most jobs in that state. What do you think California, most jobs in California?
That are desirable.
No, not desirable, available.
Well, there's probably service industries.
That's correct, number one. And that's the number one across the board in 45 to 50% of the states,
Right.
Service industry. Now, what is a service industry job? What does that mean? McDonald's? Does that mean the retail guy, the bank teller? What is service? That's all
Well,
of those,
all of
right?
those, yeah.
Right, exactly. And what we're talking about is low-end jobs. And what we really need to see is what's going to happen when the low-end job, because when the economy gets shaky, the first jobs out the door are the low-end jobs, right? Because
Well, if the certain legislation goes through and the minimum wage becomes $15 an hour in California, there are no low-end jobs, but it'll dry up. It'll
Well,
put a
that's-
lot of companies out of business.
right, and that's what we're trying to look at here when we're talking about rates and what's happening with availability of properties and what's happening with the job market and the economy. All of this stuff is happening right now. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. Email address, info@malibufunding.net. Malibu Funding being the show that sponsors this each and every week. We're close to 5 years on the air. I really am appreciative of the audience that has listened and listened to us each and every week. It's the one thing about the mortgage industry is that we're talking about money. Anything that talks about money, a lot of people shy away from it. But when it comes to real estate, it seems to garner a lot of people's attention. People get excited about it. The reason is because anybody can play in the game. You don't have to be altogether smart. You don't have to be altogether clever. You don't have to make a ton of dough. You can get into the real estate market in any number of different ways. I have a friend who was telling me about note buying on the secondary market. Now, what is note buying? So there are many ways that people do mortgages or loans of any sort. And most of the loans in this particular seminar were first liens, meaning that let's say you own a house right now and you have a mortgage. Well, they don't call them mortgages in California. They call them trust deeds. So you have a trust deed and a note. That particular note can be bought and sold by any number of different people. Doesn't necessarily have to go to Fannie Mae or Freddie Mac or Ginnie Mae. It doesn't have to go to the large institutional investors. Now, back in the 80s, when interest rates were 18%, a lot of sellers carried paper. What does that mean? You would buy the house, but the seller would be the bank, meaning that, okay, give me a down payment of 10%, and I'll be the bank, and you pay me whatever the mortgage rate is at the time. But it was the only way that we could buy and sell properties in that time because, quite frankly, nobody could afford 18% that the bank was going to charge. So those particular In those particular instances, that's a note. The seller had the note. The seller can take that note, sell it to somebody else, sell it to somebody else. So in this seminar, and again, this is about real estate and the different things in real estate that most people don't know about, but are very, very interesting and lucrative if you have the patience, the understanding, and the knowledge base by which you can go out there and invest in different things in the real estate world. So note buying in our particular market by this particular seminar, first liens, meaning you get a mortgage, that's a lien against your property. It's recorded against your title, and then that becomes the instrument which is bought and sold. So if it's not a Freddie, it's not a Fannie, it's not a Ginnie Mae type loan, it's a loan that is and we talk about it all the time on the show, non-QM, non-qualified loan. Or, as I talked about in the previous segment, it's a stated loan. Or maybe it's a hard money loan. A lot of these hard money loans are made for investors who are flipping properties. A lot of properties that are bought and sold quickly, they haven't got time to go to a lender. They don't want to go through the scrutiny of that particular process and wait and maybe, because opportunities of purchasing property come up and you got to move now. We had earlier on the show Reed Blake talking about business lines of credit and unsecured capital to be able to use by businesses any way you need. So that's a way a business, let's say you're incorporated and you have your own little shop, whatever it is. You could be selling widgets and have a restaurant. You could be a yoga studio. I mean, I don't care. But if you had extra money, you could go out and use that money based on what Reed was talking about to buy real estate. Well, you could also use that money to buy notes. You can use, a lot of the equity in your home to cash out conventionally and then go and buy a note. So this first lien that's on a property based on it not being able to be sold to Fannie or Freddie or Ginnie and, is not quite traditional loan. There are needs for investors to purchase these loans. Some of the loans are performing and some of the loans are not performing. Now, what do I mean by that? Well, if you pay your mortgage, that's called performing. You don't pay your mortgage, you're non-performing. Now, in the days of 2008, 2009, 2010, there were a lot of underperforming or non-performing loans. Let's say you're late 30 days. That's underperforming. Let's say you're late 90 days. That's underperforming. If it goes beyond 120 days, that's a non-performing loan. And then all the nasty things that happen after that from the lender. But let's say you just don't pay. And that particular note that your lender has, they don't want to deal with it either. They want to shuffle because it's expensive. And in a state like California, it's very difficult to foreclose. There are so many regulations in regards to being able to foreclose on a property that a lot of lenders just don't want to deal with it. So they discount the note and they sell it to note buyers. Note buyers take a hold of the property. Now they've bought a note, maybe 80% of the note, the face value, and if there's any equity in the property, you're now looking at a process by which, if you had to foreclose, rather than trying to work with the borrower, which is a requirement, by the way, in California, in order to have them get back on track and start paying their mortgage, there's significant equity as well as the discounted note. There's a lot of room in there by which you could say, okay, I can justify losing some money for several months by them not paying when the payoff after I secure the property and then resell it on the market is significant. So the reason people get into note buying is because they see the potential to make a lot of money. Now, what's the downside of that? I'll tell you what the downside is. You are basically carpetbagging, the term that they used after the Civil War when the northern investors went down south and just bought up all the properties and, were just nasty to the people that lived there. Well, that's kind of how you got to be. If you've ever gotten one of those calls by a bill collector because you missed a payment or you just didn't want to pay anymore, yeah, they're nasty, they're harassing, that's the kind of person you have to be if you want to get into that particular business. But a lot of people who don't have I'm painting it like it's an ugly, terrible thing. I'm sorry. Maybe you are the type of person where it doesn't bother you to call people up and say, hey, you owe me money, or hey, we're going to foreclose on your property. If that's the type of person you are, note buying may be the type of situation that you want to get into. And it's a great way to make money. You know anything about this, Darryl?
I've been on both sides.
Okay. Yeah. What's your experience there?
Well, I mean, my first major I shouldn't have done this, was I bought a set of encyclopedias.
Right, okay.
And I was supposed to make monthly payments on it. And I didn't for one reason or another. And this guy would call me at 6 o'clock in the morning every Saturday.
It was just you were on the list. That was the time.
Say, I want you to reach your hand in your back pocket and pull out your checkbook. Write me a check for $50 right now and put it in the mail. I said, I'm not gonna. He says, no, you gotta. You gotta do it right now.
Oh, man. Well, we're laughing, right? $50, everybody out there who's listening is thinking $50. Heck yeah. It's like saying, okay, 500 or 5,000. Imagine someone every week calling you on that phone.
It was like he was asking, this was before there were any rules about, there are rules that govern these people and what
Absolutely
they can do.
That's exactly right, because the harassment on somebody who owes money is huge, and anybody who's been under the thumb of that knows exactly what I'm talking about.
And when I told him I wasn't going to write him a check, he said, you're a low-life scumbag.
oh, that's bad.
Yeah, and then he would get insulting, and then he would...
Of course. And then he'd call, and I'll call you next week.
He'd probably hang up and turn into Cinderella and then make another phone call, right?
Right,
I mean,
exactly.
He's probably the nicest guy in the world. But there are people that can walk away, clean their conscience, and live the rest of the day.
It's a job.
I'm not
that guy either. Yeah. But as I said, there's a lot of money in note buying. There's a lot of money in buying underperforming loans, but you can buy performing loans. A lot of people who make loans privately don't want to keep it on their books because they want to churn the money. It's about the fees for them. It's not about long-term, 4.5%, 5.5% on hard money. It's not that at all.
And they don't talk to you about it.
No.
You're not involved as the homeowner.
That's right.
Right. My mortgage was
exactly
sold 2 weeks after I bought the house.
Right.
And I get all this paperwork. I'm going, what the heck?
Who are these people?
What's going on here? They've never heard of them.
Right.
And all of a sudden they're going, we're your new mortgage holder.
I know. It's, most people, and this is a quick aside from that, if you have a mortgage or you're getting a mortgage, you will sign in your mortgage documentation the right of that particular lender to sell your loan to anybody. And if you don't sign that, they're not going to lend you the money because most of the lenders sell their mortgages to Fannie Mae or Freddie Mac. Thanks, Daryl, for jumping in. I really appreciate it. I'm Jeff Barton, your voice for the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.